Hey everybody, welcome back to the Commercial Real Estate Library Podcast. I'm Dayma Tamanawala, you know my co-host Garret McGilvery, and joining us today is Colin Lynch, the managing director. I know this changed not too long ago, a while ago, but managing director and head of alternative investments at TD Asset Management. Thank you so much for joining us.
Well, it's great to be here. Thanks for having me.
Awesome. We appreciate it. So the first question is, what is TD Asset Management? What are you doing with alternative investments? And everybody knows TD. Some people know Greystone. Some people know asset managers generally. But I think that means a different thing to real estate people sometimes. So
Sure.
If you could give us a little bit of an overview.
So TD Asset Management, let's start there, is part of TD Wealth. TD Wealth has roughly $1.2 trillion of assets under management. TD Asset Management is the asset manager, has both institutional clients or investors and retail investors. Within TD Asset Management, we have just short of $500 billion of assets under management. Within TD Asset Management, there's 4 big investment areas: public equities, fixed income, what we call asset allocation, which is investing across multiple different types of asset classes, and alternative investments. So I'm privileged to lead alternative investments. Within that, we have Canadian real estate, international real estate, Canadian commercial mortgages, global infrastructure, private debt, which is investment grade debt, think private corporates, infrastructure, et cetera, and sub-investment grade debt, which we call global private credit. Within that platform, it is just over $41 billion in size. So that's the overview. The team is located from Singapore through Vancouver, Calgary, Regina, Winnipeg, Toronto, Montreal, London. And later this year, we'll open New York. Now, for clarity, we invest investors' capital.
Okay.
We do not invest the balance sheet of the bank broadly. Okay. So we don't do leasing of bank branches or leasing of office space or the TD Terrace, which is built by the balance sheet. We were not involved. Our mortgage lending philosophy is our philosophy. It's not the bank's philosophy. So that's very important to clarify. You won't see a TD logo on what we own.
Okay.
Whereas where you see TD logos, that is done by a completely different group called Enterprise Real Estate.
So then just to take it one step further, what is the investment? What does that typically look like? Are you investing indirectly into other funds? How does TD Asset Management alternatives get involved?
We are investors in the sense that we own and run funds.
Right.
So we're the GP.
Got it. Okay.
We raise money from institutions. So whether it's a pension, endowment, foundation, et cetera, those institutions are primarily in Canada, though there's a big effort now underway to raise money outside of Canada. And we are raising more money from the retail world, right? So, but to answer your question directly, we are the GP.
Yep.
And 9.5 times out of 10, we are investing directly in properties or companies that we own.
Got it.
The only exception is international real estate. We have invested as an LP in some international funds, in addition to our direct investing that we do. And then in Canada, we make an exception. We are an LP in some king set funds, though we're very active. We're on the investment committee of a number of them, on the boards of others. And in our mortgage program, we have participated in funds to provide high yield exposure, whereas our mortgage fund is principally an A-note first position secured position fund.
And I guess for the mortgage side of things, are you guys investing in that directly, or are you? Okay.
That's right.
Not through like KingSet as an example that you already
Correct.
brought up, through their funds.
Yeah, that's right. So you can think of it like 90+% of the book is invested directly. And then the remainder we will invest through a KingSet to provide the higher yield exposure.
again, I'm asking for everybody else, but just so I'm clear. So what is that then? Maybe give us an example of what one of those investments might look like. I think that
Yeah. Right now we're sitting in downtown Toronto. Just using examples here in Toronto on the real estate side, we would own, looking at the street, Sugar Wharf. So we built that with our partner Menkes 80-20. We owned 80%. Menkes has owned 20.
Oh, okay. I'm there. I got it.
Okay. And so we've got, but that's an important actually example, right? So that's a multi-phase development. The office is income producing. It's a long-term hold. We built that. It's about 650,000 square feet. We've got the block 2 is what we call the next phase, which was affordable rental, about 270 units with about 1,450 condo units above that. And that's complete. We own the rental. Obviously, it's strata for the condo. Block 3 is a park. Right now is a temporary park. And then block 4 is the next phase, subject to market conditions. That's one example, but I could go on. 777 Bay is a fully leased office tower. We're, I believe, 98% of that. We tend, in terms of our MO for Canadian real estate on the equity side in Canada, like to own more than 95% of the properties that we own in the portfolio. But we tend not to like to own 100% because we like our operating partner to be fully incentivized to ensure great outcomes. Because when you actually own part of the project or the real estate, then you feel it on the good side and also on the challenging side.
Gotcha. Get in the game.
Exactly. We do not do any property management in-house.
Yeah.
So the day-to-day leasing on a res book is not done by us, and we have no desire to do that in-house. However, we do have very close oversight on everything going on.
Interesting.
So, major leasing, for instance, in the office book or in the retail book does come to us for approval.
Understood.
So we are quite closely overseeing the management of properties on a weekly basis throughout the entirety of the portfolio. So we are not passive people. We are the investment managers. We have clients that pay us investment management fees.
Yeah.
And we perform that function quite directly.
Okay.
We put very clearly, we are not LPs as it relates to the Canadian real estate market.
Would you be able to give a brief overview of where you get your money from?
Yeah.
You talked about, obviously, the wealth management portion, 1.2 trillion, but then there's an allocation, I imagine, that goes to your division?
No. So we go out and raise money directly from institutions, right?
Okay.
An endowment, for instance, at a university, they have different managers to do different things, private equity, venture cap, infra, stocks, Canadian equities, but they would also look for real estate managers. So they do run an RFP. We compete in that RFP against other people like Bentall or Manulife or Fiera. And we would hope to be granted the opportunity to serve that endowment fund, right? And they would make an allocation to us and to our real estate fund. So that's basically our bread and butter. However, the point about our location within TD Asset Management and within TD Wealth, the world's getting more nuanced, right? So there are some clients that hire a firm to help them manage the entirety of their book, right? So rather than hiring 16 managers, they hire one manager and say, we want you to invest half in public equities and 20% in Canadian real estate and 30% here. Those clients are managed by our asset allocation team within TD Asset Management, right? And that's just a function of how, different clients require different things depending on their size. Smaller clients like one approach sometimes and bigger clients like another approach other times. And so we're able to accommodate all those different approaches, whether it's, through a mandate directly Canadian real estate or through a mandate that is broader in terms of alternative investments, or through a mandate that's broader all investments. And then even more complicated, perhaps, is when you get into the land of family offices, when you get into the land of high net worth individuals, and there's a different regulatory construct, different requirements. And so therefore the investment solutions that are offered have to be almost by definition a bit different. But nevertheless, and we're not the only ones on this journey, what is exciting is the ability to provide private market access to those individuals that traditionally haven't had that access. And we're not the only ones who use the term democratizing access to the private markets. But we think that there is a very bright future there. In addition, for us, to a bright future globally, because we do think Canadian real estate is one of the best performing markets in the world, backed up by data. And so we also think that that story's been underappreciated around the world. Yeah. And so we think that there's robust opportunity for us. We've been spending a lot of time, and it's not just in the context of real estate or alternatives, but within the context of TDAM, a lot of time on how do we serve clients internationally.
Okay, I feel like I'm caught up now. You said it. You said a bunch of companies that I know really well, and now I get it. Okay, can we talk about Canada on a global stage?
Yeah.
It's late July, 2025, uncertainty everywhere, according to some, and some folks may see this as awesome opportunities everywhere. Some people are nervous. And I guess, how are you looking at Canada on the global stage relatively? Let's chat about that, and then maybe we can dive into specific assets as well.
Yeah. So you might have gotten a sense of how I feel about Canada.
Yeah.
I have lived and worked outside of Canada, first off. And so I just passionately believe in the country, period, full stop. But then if I sort of check that, call it more emotional comment about Canada and back it up with some rationale. So whether it is, we've had a very robust population tailwind, and I know the picture's gotten a little bit more complex, but you step back and it's been long-term very robust across decades, regardless of political affiliation. We have more limited per capita supply of whether it's office or retail or warehouses or apartments relative to the US. And a more relevant comparison might be on a global basis. In some places we're a bit higher, like retail, but other places I'd say a bit lower, like apartments. And then we have geographical constraints. GVA is a great example for obvious reasons, ocean and mountains. Toronto, we have political constraints, which have been tested, but proven that they're not going to move much, right? In the context of the Greenbelt. Montreal, you got an island, and I know you got the North Shore and South Shore, but you got more geographically constrained desires and the political will to densify. And so logically, you have had that as an underpinning to some of the real estate strength that we have seen since the early 90s. So, if I step back from real estate and think about the country, we have some problems that we are now addressing. Well, I hope we are now addressing. If I go back to 2011, when I was leaving business school, I was fortunate to help organize a trip of people from Harvard Business School to Canada to meet with a number of leaders across industry and in government. So whether it was cabinet ministers, Mark Carney at the Bank of Canada at the time, to folks such as Prem Watsa at Fairfax, it was a great 3 days, 2 in Toronto, 1 in Ottawa. Kevin Lynch had just finished with the Privy Council. He was the clerk of the Privy Council, which means he was head of the civil service. And in our meeting with him, guess what he talked about?
How awesome Canada is.
Well, we all like Canada, but he talked about our productivity challenge. This was in 2011.
Right.
Our productivity challenge. Well, everybody's talking about it now. And so in this period of whatever we want to call it, concern, turbulence, we have the opportunity to actually now address a problem that has been around for a long time in our country.
Yeah.
Right? And it's multifold, and I could go on and on and on. It's probably not the subject of this podcast, but just think about innovation and scaling.
Yeah.
Think about the companies. We have highly educated workforce. right? We have a great education system, universities and colleges and et cetera. And if you look statistically, people here study more so than other countries around the world. And it's so great that many people want to come here, right? So many, we've had to change the immigration system. And they found companies. And we actually generally have a highly innovative and entrepreneurial society. What's the problem? Scaling. We have a challenge scaling companies. And the issue for Canada is back then in 2011, it was all about diversification of the economy. And that still applies today. But we also have a dramatic technological revolution going on. It's been going on for decades. And we're just accelerating that in that path. And our inability to scale innovative companies is a huge challenge for our country, and we have to solve it. Right? We have the capital in this country.
Yeah.
We have the people in this country. Yes, it's a smaller population base, but many countries around the world solve that too. Mm-hmm. We can do it.
Yes.
Right? That's one thing in a suite of things. And if this environment today creates the emergency alarm bell, then that's great, right? That's the opportunity for this country. That was a soapbox.
No, I love it. I mean, and I share your opinions too. Like when I was in university, I went to Western and I tried to start a startup at Communitech. It actually did okay. But you see all the innovation and the big brains out of Waterloo and Toronto and all the other great universities that we have, Western. For instance.
You should have mentioned Queens.
Queens. My mom went to Queens, yeah. And I see a lot of opportunities, but then the big companies, as they grow up, they go immediately to the south. So
Yes.
if we can retain that talent and grow them up here, do you have any ideas for that before we go on to an overview of?
Yeah. And I'll just extend that thought and then give you the idea. It's not just company scaling and creating employment, but when the company scales and the founders do well, what do? They invest in other innovative companies. So you create a bit of a flywheel.
Yeah.
And it's that community that grows that is what creates this benefit. In 2006, I studied this as part of a study. And it basically, we're looking at innovation and research clusters and the growth of Silicon Valley, the Research Triangle, and in Boston, the greater Boston area. And you need, capital, you need government, you need the private sector, and you need universities, all working in the same direction.
Yeah.
To create that community that helps grow.
But by the way, to your point, you see that is exactly what Communitech is, right? It's all the BlackBerry founders reinvesting, and then now you have Google, you have beautiful allied offices next door, and so on, right? So
and so A, the solution is more of that, but B, more importantly, the solution is capital willing to invest more materially in this space, which is a bit challenging because if you think about it from like if you hold capital, let's just think about it. You can invest $1 billion in infrastructure, right? And you can buy 2 assets. How many people does it take to deploy $1 billion in venture cap? If you're doing it on a direct basis, a lot more people than infra or real estate. Right. In addition to you got a knowledge gap and you got a perception gap around risk.
Right.
So that's what, in my view, we need to solve.
I was just going to say, do you think real estate was just too good of an investment for Canadians? Because then that would just have diverted funds from other opportunistic venture cap activities.
The short answer is no. And the reason is if large Canadian investors had half of their investments in the private markets over the last 40 years, then maybe I'd have a different answer. But reality is you go back 35, 40 years, we were in a 60-40 environment, right? It was 60 equity, 40 bonds, right? And it's only in the last sort of 30 years, starting with the biggest Maple Eights and then graduating all the way down through the smaller and smaller institutional investors, have we begun really to grow the private allocation of which real estate's at the forefront. And so I don't think it was, hey, real estate was set it and forget it. Times are great, and so why would we look beyond? It was more, from my personal perspective, around some of the tables where we sort of looked at venture cap and unsuccessfully trying to get other investment committee members around those tables to invest in venture cap. Mm-hmm. It was more the perception of the riskiness and the volatility of those returns and your ability to replicate venture cap using small cap equities at a fraction of the price. Right? So to me, it wasn't a real estate versus venture cap thing. It was more what I just described.
Yeah.
Notwithstanding, I mean, it's been a great ride, right, in real estate since, the early 90s.
Everybody wants to get on the bus when it's driving forward.
Yeah, of course. And does TD Asset Management do venture capital?
No.
Okay, all right. So good. Okay.
So this was very much my personal.
Maybe you should start.
Frank, I have been involved.
A lot of good points, though.
It's more country thing, right? Mm-hmm. And whether you're, an investor in the public markets or not in the private markets. And you look at our country, could speak on other points as well, but I do think you have to really understand where you're investing. And for Canada, I'd say this is an area that has held us back. And it's just become a lot more apparent because a lot more people are talking about productivity. But you have to drill down into understanding what's created this dramatic gap, between us and the U.S., but not just us and the U.S., other countries.
Right.
And this is just one of those areas. But I think there's great venture cap investors out there. There should be a lot more in Canada, and they should be a lot bigger.
So one thing I'd like to get to is real estate.
Yes.
We can start wherever you'd like, but you guys are invested across the board. And so, we mentioned one of the big office buildings over there in collaboration with Menkes, 777, I think you mentioned.
That's right.
Maybe we can start with office and then kind of go across the board. Like what's happening in each of these markets. You can be as specific or as high level as you'd like.
Office is obviously being a favorite topic in real estate.
Yeah.
We own office from St. John's, Newfoundland through Vancouver. And the reason why I begin with that is the office for us is performed differently depending on unique dynamics of the market. One of the unique dynamics is commute times. So where we have had office in Regina, Saskatoon, Winnipeg, where you can get in your car, commute to work, it's 10 minutes, 15 minutes. Swipe data for us indicates that physical presence all the way from 2021 to now has been a lot more robust. And so for me, one of the proof points on the vitality of the office is around ease of access to it. And that matters a lot more, I'd say, today than it did in 2019.
Yeah.
Then within these big centers, it is all around proximity, which is not different than 2019. Proximity to transit, major transit. And we've had that theme for our investment thesis in the office space, but writ large, not just office, but sticking with office. That's been our theme for years and years pre-pandemic.
Right.
But it's just become a much more important theme today. And why is that? Well, I actually think commutes got worse for a variety of different reasons and the like. But also the reality is we are still bringing people back to the office as we sit here today. And the incentive to come to the office matters. And part of that incentive is it's easy to get here. Part of the incentive is the fit out. Right? Part of the incentive is the amenities. And that story has to be attractive still. And so, yes, I think I'm sure a lot of people talk to you about the bifurcation and, AAA, AA performs a lot better, et cetera. Yes, absolutely. And I think that is all a function of what I just said. And so we see that in spades. Fortunately, we've been oriented towards transit locations. We sold out of positions pre-pandemic and actually through the pandemic that were less well located, suburban office, for instance. And so our portfolio, where we have seen leasing, and we've done a couple million square feet of leasing in our office book in the last 9 months or so, where we've seen that happen is in offices that are well located. The 320 Bays Street as another example of where we've done a lot of leasing. There's been some idiosyncratic stories. So 777 for the Bay, very important office building for the provincial government here. Number of cabinet ministers in that office building. That's been a very strong performer throughout the pandemic. In addition, there's been other elements to the office story, like life science. And we have some floors in that building leased to the University of Toronto, the dentistry, and the med school, where there is life science activity happening. We invested capital to fit that out, so did the university. But we're very happy with, I believe it's a 99% lease building, which is different than the life sciences story going on in the States. And I could speak ad nauseum on that one too, if you want. But a very different story happening in the States there.
Right. We just don't have the supply to accommodate.
Yeah, we don't have the supply. We also didn't have the dramatic capital rush. We also didn't have, if I go back to clusters in our convo on venture cap, it's similar to life science, right? Life science originates out of university, medically intensive universities. And their teaching hospitals are where life sciences interacts between the medical school and the teaching hospitals. Physical proximity is important as a result. And so there is a lot of strategies around conversion of office buildings that were physically quite distant from the universities. So if you're a faculty member that's tenured with your lab, are you going to like a half an hour commute to some office building? No, right? You're going to prefer the lab next door to where your office is, right? So that physical proximity has been very important. And then the world of academia is very much focused on, I don't want to say prestige, but I'd say the reputation, right, of the university. And so there is certainly a premium, let's call it, for the most renowned universities, which also matters if you're investing in the life science real estate that serves a lot of the researchers working in those universities. And ultimately, these are startup companies and scale-up companies. So therefore, the credibility of said university, the credibility of some of the pharma companies funding some of the commercialization and scale-up efforts, all that's super important. And so all I'm saying is you can look at it from a risk perspective, you can look at it from a return perspective, and as the gush of capital and the wave of capital went in, I'd say some of the risks were underpriced in some areas, and as a result, there's a lot of overbuilding. And as the wave of flow of funding into that sector receded, you're seeing some of the call it underpricing of real estate risk exposed.
So office, flight to quality, introduction of life sciences, prestige of universities. There's innovative ways to guarantee success with an investment. Sorry, I'm just going over it with a very crass brush. But okay, office, check. Industrial.
Very interesting space. So,
and by the way, sorry, wherever you see you want to add it in, like the AI stuff.
Yeah.
The revolution of AI. I get a new update on my phone on like the 8 different apps that I have every day, whether it's X or Gemini or ChatGPT and so on.
Yes.
I must be paying like $1,000 a month with these things combined.
Yeah.
What can you do? But how do you see any of that playing into your strategy?
So within the alternatives world, private market world, and it's a little bit of nomenclature, but we put data centers in our infrastructure bucket because a lot of that is around energy and sourcing of energy. And if I 2 cents on or 2 secs on that point, energy demand is going to grow dramatically.
Yeah.
And it doesn't matter whether it's renewable energy or conventional energy, we're going to need more of it. And so long-term, we're incredibly constructive on our infrastructure book, irrespective of whatever announcements we have today from different countries around the world. From my perspective, it matters less than what I just told you, which is energy demand globally will double by 2050. So, and why? Exactly what you described.
Yes.
So, put that to the side for a sec. Come back to your industrial space in Canada.
Very interesting.
And yeah, I had a coffee actually right before this, and I sort of described that space as a set it and forget it back in 2020.
Okay.
Right? It almost didn't matter what it was. Small bay, large bay. It could be in Toronto or Montreal, or Edmonton or Calgary or Saskatoon or Vancouver. It did spectacularly well. And why? For everything that I think all of your listeners and viewers know, right? E-commerce pulled forward. We're sitting at home in the pandemic, et cetera, et cetera. Is that theme relevant today? Yes. Will e-commerce continue to grow? In my view, yes. Did we overestimate the growth during the pandemic? Yes. Did we know that we're going to have all this trade volatility? No. And so therefore, is the sector hitting an air pocket? For sure. Is development going to ramp down? Yes. Am I concerned still about tenants that were paying $6 rents renewing at 18? Absolutely. And do I buy that it's immaterial to them? No. Why? Because economic growth is a little unstable and we have significant volatility as it relates to trade policy. So no, I'm not. My view is not that the sector's broken. Absolutely not. It's a very strong sector. My view, however, is not that we're going to have, insert the number 10% rental growth or even 8% rental growth or 15% market growth. I don't think so.
Right.
And I do think that we are having a moment where development is tempered down, as it should, because we clearly do not need the growth that we have seen in the last 2 to 3 years. But do I expect the experience of the warehouse space to be the experience of the office space? No. Right now, we're seeing small bay and mid bay as stronger performers for reasons that the large bay has been a lot of 3PLs and folks that are importing, and that's been a little bit more challenged. Right. But I still think that is a short-term thing. I think the sector is again strong. I don't want to repeat, but it's moderated back to reality. And going forward, I do not think it's a set it and forget it space anymore.
Because you mentioned transit, accessibility, and a few other key items for office. What are the top 3 that you look for in an industrial, whether mid or small bay?
Yeah, so and it's a great question too, because for a long time there was a view of expansion of the geographic proximity. We are in a world where location still does matter, which in the industrial space, that's proximity to airports. That's principally in Canada the driver.
Yeah.
That's not to say, for instance, in the GTA that Scarborough's a bad place to have a warehouse or to have small bay or medium bay industrial. It performs very well. But I do think the proximity to the major geographic centers matters a lot more today than it did 4 years ago. And so to us, yes, is it good for there to be transit service for the workers in the warehouse? Yes. Do we look at that? For sure. Do we look at the population growth and what's being developed and the prospect for development? Absolutely. But there's no mistaking the GTA Center Ice is close to Pearson Airport, right? That's Brampton, Mississauga. That's relevant. And so is it to the same extent as I described for office? No. But location still does matter.
This is going to make me sound so bad. So it's location is office, that's important, industrial. Okay.
But I would pound the table as I say location,
Yeah.
location, location for
Yeah.
office. Or I'd say, yeah, location matters for
Yeah.
industrial.
And it is actually, I'm just being silly, but it is an interesting take, because you're saying it didn't matter nearly as much, and now it matters more in both verticals, actually.
Yeah.
And then why don't we talk about multifamily, because people talk about immigration,
Yes.
student visas, and so on. And now, for the first time in a long time, we're seeing some market rents falling. We're seeing a lot of the condo developers putting projects on hold.
Yes.
People are talking about switching to rental. Some
Yes.
are, a lot are.
More than talking.
A lot are. But there's still a little bit of choppy water out there. Like, give us your framework for multifamily housing today.
Yeah. Choppy water is.
I love it.
Yeah.
Very bullish.
So we like it in our strategy. About call it 38% of our real estate equity book in Canada is res.
Okay.
And we were one of the first major institutional investors to go big in res in the sort of 2006-07 time horizon. So we fundamentally believe in res because we do believe that Canada will continue to be an immigration nation from the perspective of growing the population. Population growth is going to come from immigration.
Yeah.
It's not going to come from natural population.
No.
So that will continue to be relevant. Globally, we continue to see people moving into bigger cities. That does happen. Canada, interesting dynamic with Toronto being unaffordable and folks moving out of the city, yes. But globally, we continue to see cities grow. We continue to see households grow, which is different than populations, right? So as a side note, look at Tokyo. Tokyo, demand for rental accommodation is very strong, but Japan's population is falling.
Right.
So that's a case in point for what I described, which is people still moving into Tokyo, family units getting smaller, divorce rates pretty high. So we see, and I just used Japan, but I could give you Finland, and unfortunately, in terms of divorce rates, Canada.
Right.
So there will be demand for rental, no doubt about it. We will have immigration in this country.
I never linked those two, but that's a good, okay.
So we're going to have demand. Is there short-term choppiness? Absolutely. Is there major stress in the condo market? Yes. Right. And for a long time, capital values in the condo market ran ahead of what folks received from an income perspective to carry said condos.
Yeah.
And we just, that's not a new story. That's, last 10 years. And it's grown and grown and grown. And it's hit the breaking point at this point. And so, yes, that is a dynamic that's going to take time to sort out. And the time will be 2025. It'll be next year. We'll be still sorting it out because there's a lot of condo deliveries. And I would submit it's likely to extend in 2027 and might go even further. I mean, we've lived a cycle before. You just look at the early 90s, and it took a while for that to work its way through. Now, is it going to take as long as it did in the 90s? And yes, the 90s had a recession. Yes, the 90s had a commercial market situation in addition to resi. So it's not perfectly analogous. But the reality is there's condo inventory still to be delivered. We have changes in the immigration dynamic that are being implemented this year, next year, in 2027. Temporary population, which was at 7.4%, now is at 7.1%, and it's going down beneath 6. I believe it's 5.7%. So we have a ways to go. So therefore, I see no near-term change in the condo market. Meanwhile, you have, condos projects transforming into rental.
Yeah.
And if you look at the pipeline, there's going to be a lot of rental being delivered. So my hunch is we're going to be making major strides in our affordability problem.
Right.
And, writ large for the country, that's not a bad thing. Now, the government's going to underwrite a lot of those major strides. And when I say that, you have to caveat. Because on the one hand, yes, CMHC plays a major role, right? And yes, municipal property tax abatements is important. Mm. But you also have to look at the other side, which is the cost of construction, right, is heavily laden with government taxes and fees, one way or another. So it's take from one hand and give with the other.
Yeah.
But net, yes, the affordability problem will become less dire. And that is not a bad thing for the country. It's a bad thing for certain participants in the real estate industry that might have bought at the top of the market land and now are sitting with it and will have to sit for quite some time.
Right.
But net, we will get through it. There will be more rental delivered. And just like other pieces of the real estate world that has gone through a cycle, we will be going through one in the rental space. But that doesn't mean the space is not strong. It is a strong space with high occupancy.
And still, just because of the condo inventory and then the rental inventory in 2025, 2026, and 27.
Plus immigration changes.
Anticipating lower rents, at least up until that point.
Yeah, and that's a headline story, right?
Yeah.
You also have, there's a lot of apartments where folks are paying in-place rents that's half of market. Mm-hmm. So market rents might come down, might not actually impact your NOI line if you own that apartment building.
Right.
Now, also a dynamic was turnover used to be 33%, right? It's fallen down to, in certain places, 9%.
Yeah.
So, and that's just a function of, of in place being much lower than market. Well, as that dynamic changes, turnover might change as well.
Right.
So there are many pieces to that story that that's why I say writ large, the sector is still very strong, right? But it's certain places in that sector that, it's going to be more challenged.
Yeah.
Right. A $2.50 rent story and leasing of that property is very different than relying on $7 rents. Mm-hmm. Right. So it just it all depends. And I think that's a broad theme in real estate. I'm not fully there on this theme, but certainly the last decade has been closer to a set and forget it sort of decade where you're playing more sectors, right? Overweight beds and sheds.
Yeah.
And you're good.
Easy.
Right?
Yeah.
I'm not sure it's that straightforward or simple for the next 10 years.
Yeah. You have to be really specific with your business plan and execute.
That's right.
Not relying on cap rate compression. Okay, let's touch on retail. And then I am interested, difficult when you touch everything, right? Including infrastructure, which we haven't gotten to, but other than the data center piece a little bit. But yeah, let's go retail. And then I'd be curious, like, if you could dive deep into one specific asset, like what do you love?
Okay.
But retail first.
I like talking about retail because retail was a 4-letter word, right? 5 years ago.
Yeah.
Right. Now it's office, but retail was, and then you used to say, things will change. It's a cycle. Mm-hmm. And I think that's the lesson for life, period, right? Like if you assume today is tomorrow, you're going to have a problem because the only thing constant is change, right? So ditto for retail, right? Last year's best performing sector in Canada was retail. So a lot of resilience now brought to you by people still getting back and living life in physical form and enjoying shopping and some rebounds. And we had inflation running through the numbers and percentage rent, which usually is really bad. It was not so bad because you got the benefit of some of that inflation. Baskets got larger, footfall was up and up to 2019 levels. And it didn't matter where you're talking about necessity retail, which was underappreciated in 2019, that everybody wants this, necessity, essential retail today. It's all the rage everywhere. With logic, right? We saw proven through the pandemic that we're going to line up for our groceries, right? 6 feet apart. but we're still going because we got to eat.
Right.
So people saw necessity retail being attractive. But I think what was the surprise was that enclosed shopping centers did quite well. Mm-hmm. And so you see, return, we're not normal yet, but a much more functional capital markets for retail centers. And, a ton of demand for essential retail. Growing up, I used to call it a strip mall, but
right.
essential retail.
Yeah.
The interesting thing is in a lot of books and diversified books, it's actually I shouldn't say very small. It's a smaller proportion of people's books, certainly compared to resi, industrial, and even some office. And it's because it was a sector everybody ran out of and valuations compressed. Going forward, is there some turbulence? Yeah. But I would say that turbulence doesn't keep me up at night because it's connected to the economy. Mm-hmm. Right? So it's sort of, we have a recession, people spend less. Absolutely. Now, yes, we had Hudson Bay, for sure. But I would say that if that was keeping you up at night this year, you weren't doing your job, because that was and I feel very sorry for folks involved working at HBC. Many people are, they got put out, right? You're talking, I think it was 8,000 employees, like a large number of people. But as a real estate owner, you should have seen that coming. Yeah. And so today is not the day you should be creating your plan for what you're doing with that space.
So same question then for infrastructure. Where are we today?
Yeah. So infrastructure is a whole different space. Mm-hmm. So infrastructure, most investors are really underallocated to infrastructure, especially beneath the big Maple 8. But you think about the smaller institutional investors. So many people are just learning about the space.
Yeah.
And just increasing allocations to the space. Infrastructure is a little different than real estate because it's very broad. Mm-hmm. So not just data centers on one end, you have energy production, energy storage, energy transmission. You have transportation infrastructure, airports, you have highways, you have some railways in certain instances. You have social infrastructure. In parts of the world, you can invest in hospitals, for instance. And so it's a very, very broad space.
Right.
People are just learning about it. And so capital is flowing. And capital is flowing at unprecedentedly high levels. That doesn't mean that capital will crest or decline. No, I actually think more capital is going to flow into the space. And so we're just at the beginning of that journey. Why? I mentioned the energy thing, but if you look at the public purse, i.e. the government purse, is stretched. Mm-hmm. And these are things that used to be the domain of governments exclusively in many instances, highways, airports. Purse is stretched. So government has to look for private sector participation. And we see it all around us. And so this space is going to grow and grow in terms of the demand for infrastructure investment. So sun is just rising.
Right.
Discount rates are very different. In our infrastructure book, our discount rates are double digit. And so our returns on our infrastructure portfolio, since inception, we're looking at 16, 17, 18% annualized returns for what we call essential infrastructure.
Wild, because it seems like the safest.
Right, with long-term contracts.
Yeah.
With whether it's utility providers or governments or the like. And so, yes, there's some logic for the flow of capital that we are beginning to see in the infrastructure space. What keeps me up at night is generating those returns going forward. Because, again, when you have lots of capital, values go up.
Yeah.
Competition goes up. Returns go down.
Yeah.
So ensuring that we're able to deliver those returns is important. But if you step back, infrastructure might be where real estate was 30 years ago. Right? It's got a long run.
Can you just give a quick example outside of data centers, some of the infrastructure assets that you own?
So we own a company called Infinite, and they are based out in Alberta. And it's a really interesting company because it provides backup power to the province of Alberta. And so when there was energy challenges in that province in the winter, we provided the backup power because there was a lot of brownouts. And so that, resiliency comes at a fee, but we were able to provide that. And that's very meaningful. We own a portion of Silicon Ranch Corporation. That's a solar farm company based out of a number of states, headquartered in Tennessee in the USA. And it does, as the name describes, operates solar farms, but also builds solar farms. And that company, to give you a sense, when I joined Greystone, that was a $20 million investment. It's now $1 billion for us. We own ports in Europe, so in the Netherlands, in Italy, and it's as described. Also in the United States, we have about 20 million containers that flow through our ports every year. The infrastructure program has about 3,500 employees within the 9 platforms, but you can think of them like companies. They have their management teams, they have their boards, et cetera, that we own. We have Rabsha Craft, which is a platform in the Nordics, based out of Sweden, that we've expanded to Finland and to Ireland. Think wind farms, think biofuels, the spectrum of renewable energy. We're excited because we're going to expand it to more countries. We're going to have additional forms of renewable energy. And so we like that approach of having, we call them platforms, and scaling those platforms to meet needs. And so whether it's in our transportation space through the ports or hangar facilities here, we have one at Pearson Airport here in Toronto, but also one at Winnipeg. And we've been looking at other airports across the country, or whether it's the renewable energy side. We used to own, we just sold a position at a good return in the equivalent of on-the-run locations, so service plazas in Connecticut. And so, lots of folks drive up from New York through to Boston along the seaboard. We owned a bunch of facilities there, et cetera. So that gives you a few examples for our info portfolio.
Yeah, that could be its own series of podcasts.
Yeah. Yeah. Okay. I don't mean to make you choose one of your children, but it sounds like perhaps infrastructure.
I didn't even talk about mortgages.
Oh, sorry. Okay.
But you want me to choose, huh?
Yeah. Yeah.
That's tough because, we didn't talk about real estate outside of Canada.
Yeah.
And where you've seen a lot of compression of returns, which is poor performance, but it rebounds, has been in the United Kingdom, for instance. So we stepped into positions there and we've done very well. Yeah. We stepped into positions in the Nordics where you saw cap rate expansion. And now we're beginning to see a lot of rental growth and some compression in cap rates. In the United States, we've just had, if you look at the Odyssey Index, 3 quarters of positive performance. And so we're very excited there, where we have teams active now looking at deals in the United States. We've done 3 portfolios in Europe in the last year and a bit. We're active on a number of opportunities in Europe. We're active in Australia, looking for opportunities. And all we're doing is we're chasing the value adjustments where they've come down, and we've got confidence on location. But more than that, where we've got confidence on the real estate, we're going in and acquiring.
Right.
So
do you have an ideal check size?
No, frankly. And I was telling my mortgage team, because we've had spectacular growth in the mortgage fund, I don't discriminate against profit. Okay. Profit on a small deal is great. Profit on a big deal is great. I think one of the dangers and one of our lessons is to get romantic about big deals. Like if you look at some of the stress in the system, writ large in real estate, and not just that, even some of the stress in some of the infra system as well, has come from some of those big deals. And so I don't have any notion of going out and saying, I want to do that deal because it's a $500 million, billion-dollar trophy. No, not at all. Like, it's math, it's numbers. Numbers are a law.
Right.
And so, I know you can make an argument about, you do a bit more work transacting, but like that's minor compared to all the asset management work that you have to do through the lifespan of a property or operating platform in the case of infra.
Right.
So no, it could be a $50 million check size. It could be a $15 million check size, and it can be a $200 million check size.
Right.
The key to me
is that it's not a $1 million check. No, I'm kidding. I'm just kidding.
To the bottom.
It's the position in the portfolio and the role it plays, and also the underwriting for that investment.
Right. And then, sorry, okay, so we've been at this for a little while, so we should wrap it up soon. Although this could go on forever. Do we want to just quickly touch on mortgages? You mentioned them a little bit.
Because you were trying to get me to choose, and I'm sidestepping the question because it's hard for me to choose.
Okay.
We've had phenomenal run in mortgages. Also, I think underappreciated, even institutionally. If you look at a lot of investors that are investing in fixed income, and the experience in fixed income has been, I'd say, okay over the last 5 years, and you have the ability to access well-performing real estate secured in many instances, first position, LTVs 50%, 40%, 60%, in 90% occupied properties in a fund producing, what was fours and then became fives and sixes and sevens in terms of income yield off of that first position. And you compare that to public bonds, for many, it was a no-brainer. So we saw a fantastic growth. Importantly, we still think that thesis applies.
Right.
And we still are seeing a significant premium over other fixed income without the commensurate increase in risk, and in many instances, a decrease in risk. And so I think it's still a very relevant place to be, at least from our vantage point. Many details are important. First position versus second versus third. In what? Development versus IPP, location, etc. All this typical underwriting stuff you look at and more matters. But net, we've had spectacular growth in our commercial mortgages franchise because of that, what I just described, the yield premium.
Right. A couple questions for you. What's the best book you've read in the last 12 months? You strike me as a reader.
I am. I read a lot of things, but not a lot of stuff for fun.
What's something interesting?
Well, I sit on the board of Sunnybrook, Health Sciences Center, which is a hospital with a lot of sites, and it's plays a very major role for our healthcare system here in Ontario. And for one board meeting, they left a copy of this book, and it was called, I think it's called Path to Greatness. It's a history of Sunnybrook Hospital. And Sunnybrook began as a hospital for veterans. It began in World War II. It was built for people returning from the war. And there's a whole history about it, and I could go on and on and on. But suffice to say, the stories of what Sunnybrook has done, whether it's the air ambulance system, Orange, which we take for granted today, came out of Sunnybrook. Whether it is even in 2020, the Army was deployed to Sunnybrook. There was a field hospital in the parking lot. Whether it is the burn unit, which plays the role for the province. You're on a critical crash, you get airlifted. Whether it's kids that are born at 20 weeks and the survival rate for those kids. I could go on and on and on, but the point is Sunnybrook outperforms. They outperform due to the culture, and you can see that in the data. And right from day one, in terms of how the place was created. So I read that book. And the author of that book was a Toronto Star reporter who was working in a convenience store and was shot and in her teens, and she was treated at Sunnybrook. And so, that's called first few pages of that book. And, and it struck me from, the first page, and I just read it all the way through. Inspiring organization.
Okay. You were top 40 under 40, among 1,000 other accolades and things that you do. It's really cool. And we have some old listeners, some young listeners. What is, again, another very challenging question. What is the most valuable? What advice would you give to yourself at, say, 25?
Well, I already mentioned one, which is don't assume the world today is the world tomorrow.
Yeah.
Which means the biggest companies today won't be tomorrow. Which means how we talk about real estate won't be how we do tomorrow. Like everything will change. And so that's one. And two, don't assume a linear line. Right. When I started in the industry, the big debate was how high the price of oil would be. Right. And it was, I remember, I won't mention their names, but some big companies in the financial space predicting oil at $200 a barrel. And it was like a straight line to $200.
Right.
Right. So the lesson is that the world doesn't proceed in a linear line. Why? We have things called innovation and new ways of doing things. And so that would be almost a second piece. If I went back and did it all over again, I'd focus a lot closer on innovation and how that has the potential to transform our lives. So that would be the two pieces.
Colin, thank you so much. We'll have to have you back on because there's a number of items that we didn't talk about. And
sorry for long talking.
No. We appreciate it. Thank you so much.
Thanks for having me.
Colin.